In his latest essay, Minneapolis Fed President Neel Kashkari says that the central bank will need to raise rates one more time this year to keep policy tighter, longer, if the economy is stronger than expected. Neel Kashkari joins us this morning, along with our own Steve Leisman. I can handle one more. You guys were doing 75. You did 3 or 4 of those, so another 25 I can handle. What I love about the Fed is that you can institutionalize words. You remember conundrum? No one used it until the Fed started. Then there was significant, or was it substantial? And then if you say substantial versus significant, that makes a difference. Now there's 2 I want to talk to you about. What's a lag, and can you define it, and can you tell me how long it takes for it to happen? And the other is restrictive, because that's what I'm focused on right now.
Yeah.
Are we restrictive right now?
Sufficiently restrictive. That's the
phrase. Another good one. Are we
sufficiently restrictive?
Are we sufficiently restrictive right now or not?
I don't know.
All right.
Very unsatisfying. I know, very unsatisfying. But you're asking the most important question. So the definition of restrictive in my mind is where are long-term real rates relative to the long-term neutral rate? And we can't observe the neutral rate. We can kind of estimate it. I thought before the pandemic, the neutral rate was around 0% real. We're at plus 200 basis points relative to that now. But it's possible, given the dynamics of the reopening of the economy, that the neutral rate may have moved up. So one thing that makes me cautious that we might not be as restrictive as we think is that consumer spending has remained robust, GDP growth continues to outperform, and the 2 sectors of the economy that are traditionally most sensitive to interest rate hikes, autos and housing, have both indicated some signs of bottoming and in some cases are starting to show some recovery. That makes me cautious that we might not be as restrictive as we otherwise would think.
But on the other hand, John Fort, referencing John Fort. On the other hand, since we don't know about lags and how long they take, when I cook a steak on the grill, I put it in tinfoil because when it comes off the grill, it may not be. You leave it there for 5 minutes, it cooks more.
Yeah.
It cooks more, and you overcook it if you just. Maybe we're already
Steak lags and monetary policy.
Maybe we're
too. I like that, Joe.
Isn't it possible that it's getting more restrictive day by day without you doing anything?
It is possible. That's correct. And that's why we have slowed the pace of our hikes. As you said, we did 4 75 basis point hikes. Then we took a gap. We did 25. We took a gap. We did 25. We didn't do anything this past week. So we are allowing the data to come to us to try to figure out how much effect are we having in the economy and whether or not we need to do more. So we agree with that. And as inflation continues to come down, and we've made a lot of progress, I hope it continues, if policy stays where it is, real rates get tighter. So that's another factor.
What if oil stays where it is? Joe did all the highfalutin questions, which I normally do.
I'm done. I'm exhausted.
What about high oil prices? Is that something that you think in order to higher rates?
Not by itself. I mean, it can have an effect on consumer spending because it crowds out other things that households have to buy. But as you know, we look at core inflation because energy prices tend to move around a lot. And so I wouldn't look at energy price moves and say that's definitive on what inflation is going to do. But it is something that affects the economy.
Neel, just getting back to the places where you're seeing rises again, energy prices being one, housing being another. I mean, those are supply issues that you don't have any control over. So you can raise rates to infinity, and you might not be able to fix those things. Right. But those are, I mean, it's a pretty blunt tool to try and fix those issues with higher rates.
I understand. Monetary policy is absolutely a blunt tool. But when we've seen such high inflation as we had over the past few years, we have a job to do, get inflation down to 2%. We've made a lot of progress. I feel very good about that. We need to finish the job. And whether we have to go higher from here, we'll see what the data tells us.
What is the prevailing view in the room about all of these strikes and the union efforts and the increases in wages across the country and what you can and can't do about it and what you should or shouldn't do about it and what it means immediately for inflation and longer term?
I mean, I think my view is we want to see workers enjoy higher wages. I mean, that's absolutely true. The labor share of income has been declining for 40 years. That's an economic conundrum. I don't think it's a healthy thing. At the same time, we model out what do we think the strikes mean for the U.S. economy or a potential government shutdown for the U.S. economy. Traditionally, these strikes have been shorter-lived, and there's not been a big imprint on the economy as a whole, but it's something that we're watching. It's scenario planning.
But when you see the sort of significant increase that will likely result from at least some of these strikes, Do you say to yourself that's a good thing because you want higher wages, or do you think that's a bad thing because it's going to make your job that much harder?
Well, it's something that I looked at, especially a year or two ago when inflation first took off. I started paying a lot of attention to union contracts and whether they were adding back in the cost of living adjustments. In the 70s, almost all union contracts had cost of living adjustments built into the contracts because high inflation was so present everywhere. Over the next 20 years, they sort of fell away. Then they started creeping back in. So we do pay attention to these contracts for what they mean about the future of inflation and whether or not inflation expectations are getting embedded in the economy or not.